The U.S. housing market is buzzing right now, especially when it comes to mortgage rates. Recently, the Federal Reserve made a big splash by cutting interest rates for the first time in years, and this change could affect a lot of people looking to buy a home or refinance. After several years of rising rates that made borrowing pretty tough, this shift signals that things might be changing for the better. So, what does this mean for you? With inflation easing and the economy shifting gears, many are wondering if it's finally a good time to jump back into the housing market. Will mortgage rates drop, and what impact will that have on your home buying plans? In this video, we'll break down what's happening, why the Federal Reserve is making these moves, and how it all ties into the housing market. Whether you're thinking about buying your first home or just curious about the current trends, stick around as we explore what this all means for you. At present, the average 30-year fixed mortgage rate is showing signs of improvement compared to the higher rates we've experienced in recent years. If you're considering a loan with a fixed term, these rates can greatly impact your monthly payments and overall costs. For those looking at adjustable rate mortgages, ARMs, such as a 5-1 ARM, you might find lower initial rates, which could lead to substantial savings in the early years of repayment. However, it's crucial to be mindful that ARMs can fluctuate after the initial fixed period, so weighing the benefits against potential risks is essential. However, to fully grasp the impact of recent changes, it's essential to understand the Federal Reserve's role in the economy. Established in 1913, the Fed is responsible for overseeing U.S. monetary policy. One of its primary goals is to stabilize the economy, which it does by adjusting interest rates. When inflation is high, the Fed typically raises interest rates to make borrowing more expensive, slowing down economic growth. Conversely, when the economy shows signs of slowing down, the Fed cuts rates to encourage spending and investment. Recently, the Fed announced its first interest rate cut in years, dropping the benchmark rate to between 4.75% and 5%. This cut is a response to declining inflation and a cooling economy. While the Fed's decisions don't directly set mortgage rates, they heavily influence them. As the central bank reduces rates, banks often follow suit, which can lead to lower mortgage rates for consumers. So, how exactly do these rate cuts affect mortgage rates? When the Fed cuts interest rates, it lowers the cost for banks to borrow money. In turn, banks often pass on these savings to consumers, which can lead to lower mortgage rates. However, it's essential to note that the relationship isn't always straightforward. Experts predict that while rates are starting to drop, they may not plummet dramatically overnight. Many analysts suggest that we might see rates hover around the 6% mark for a while before dropping further. The U.S. housing market has faced considerable challenges in recent years. High mortgage rates have pushed many would-be buyers out of the market, leading to decreased demand for homes. As a result, home prices have also started to cool off in many areas. This environment has created a mixed bag for current homeowners. On one hand, many are feeling the pinch of higher rates, making refinancing less appealing. On the other hand, those who held onto their homes during this period may find themselves in a better position as rates begin to fall. For potential home buyers, this could be a golden opportunity. With inflation easing and the Fed signaling more rate cuts, the timing might be right to enter the market. However, it's essential to approach this decision with careful consideration. Buying a home is a significant financial commitment, and ensuring you can afford your monthly payments should always be a top priority. Generally, when inflation is high, mortgage rates tend to rise. Lenders set higher rates to compensate for the reduced purchasing power of money over time. When demand for mortgages is high, lenders often raise rates to maximize profits. Conversely, when demand is low, they might lower rates to attract more borrowers. Mortgage rates are closely tied to bond rates, particularly the 10-year Treasury. When bond yields rise, mortgage rates typically follow suit, and vice versa. Additionally, employment patterns and other economic indicators can impact mortgage rates. A strong job market may increase demand for housing, leading to higher rates, while a weak economy might have the opposite effect. If you're considering buying a home or refinancing, here are a few tips to navigate the shifting landscape. First, stay informed about market trends and potential rate changes. Understanding the current economic landscape can help you make informed decisions. Before applying for a mortgage, make sure your financial profile is strong. A good credit score, steady income, and a manageable debt-to-income ratio can help you secure better rates. Don't settle for the first offer you receive. Shop around and compare rates and terms from multiple lenders. This can significantly impact the overall cost of your mortgage. While it's impossible to predict the perfect time to buy, being patient and waiting for favorable conditions can pay off. If you're currently priced out of the market, consider continuing to save and improve your credit before jumping in. Thank you for your time. See you next time.